For years, Wall Street treated artificial intelligence like the greatest money-making machine ever invented. Investors poured billions of dollars into chip makers, cloud companies, data centers, and almost any business that could place the letters A and I inside a presentation. The promise seemed simple: build the machines today, dominate the future tomorrow, and collect unimaginable profits for decades. But there is a problem. The AI machine is consuming money much faster than anyone expected. And now, after years of rewarding companies for spending more, Wall Street is beginning to ask a dangerous question. Where are the profits? This does not mean artificial intelligence is disappearing. It does not mean the technology is useless. And it certainly does not mean that every AI company is about to collapse. The real story is more complicated. Artificial intelligence may be one of the most important technologies of the century. But a revolutionary technology does not automatically make every investment profitable. Sometimes, the invention changes the world while the investors who finance the first boom lose their money. That is exactly what happened with railroads. It happened with electricity, and it happened during the early years of the internet. The technology survived. Many of the original investors did not. To understand why Wall Street is suddenly nervous, imagine a simple stickman standing in front of a giant machine. The machine is marked AI. The stickman feeds it $1 billion. The machine asks for another billion. He gives it 10 billion more. The machine grows larger, faster, and more impressive. It can write, it can draw, it can analyze data, it can generate video, it can answer questions in seconds. But when the investor opens the profit box, only a few coins fall out. So he keeps waiting. He tells himself that the real profits will arrive next year. Then the company announces that it needs another data center, more chips, more electricity, more engineers, more cooling systems, more land, more fiber optic cables, and more billions. This is the hidden financial reality behind the AI boom. Artificial intelligence may appear invisible on a computer screen, but the infrastructure behind it is enormous. Every time a person asks an advanced AI model a question, physical machines must perform calculations inside a data center. Those machines require specialized chips. The chips require manufacturing plants. The data centers require electricity. They also require water or other cooling systems to prevent the equipment from overheating. And as AI models become larger and more powerful, they often require even more computing capacity. The biggest technology companies understand what is at stake. They believe that whoever controls the infrastructure of artificial intelligence could control the next generation of computing. That is why they are spending so aggressively. According to the Bank for International Settlements, the 5 largest hyperscale technology companies are expected to spend more than $1 trillion on AI-related capital investments across 2025 and 2026. $1 trillion. That is 1 million piles of $1 million each. It is enough money to build cities, railways, hospitals, power stations, and entire national infrastructure systems. Instead, much of it is flowing into chips, servers, cloud capacity, and data centers. The companies making these investments are not foolish. They have enormous revenues, experienced executives, valuable customer relationships, and access to some of the best engineers in the world. They can see that demand for AI is real. Businesses are using AI to write software, analyze documents, automate customer service, detect fraud, develop medicines, and improve advertising. Millions of ordinary people are also using AI assistants every day. The technology clearly has value, but value is not the same thing as profit. A restaurant can be full of customers and still lose money if every meal costs more to prepare than the customer pays. An airline can sell every seat and still struggle if fuel, aircraft, and debt become too expensive. And an AI company can attract millions of users while spending more on computing than it earns from those users. That is the question investors are now trying to answer. not whether AI works, but whether AI works as a business at the prices Wall Street has already placed on it. For several years, investors were willing to ignore this question. They believed that the race was too important. Every large technology company feared falling behind. If one company slowed its spending, another company could build a better model, attract more developers, gain more customers, and become the dominant platform. This created a financial arms race. No company wanted to be the first to stop. Imagine 4 stickmen running toward a distant treasure chest. Each one is carrying heavier bags of money. None of them knows exactly what is inside the chest, but they all know that if they stop running, someone else may reach it first. So they continue. They spend because their competitors are spending. They build because their competitors are building. And investors reward them because nobody wants to miss the company that might become the next dominant technological empire. This is how a genuine innovation can also create bubble-like behavior. A financial bubble does not always begin with a fake product. Sometimes it begins with a real invention and an exaggerated expectation. The internet was real in the late 1990s. It transformed communication, business, entertainment, shopping, and almost every part of modern life. But investors still placed absurd valuations on hundreds of internet companies that had weak business models and little chance of surviving. When the dot-com bubble burst, the internet did not disappear. The unrealistic expectations disappeared. That distinction matters. Artificial intelligence can transform the global economy and still produce disappointing returns for some investors. Both things can be true at the same time. The market began showing this tension more clearly in late July 2026. Technology and semiconductor stocks came under pressure as investors questioned whether the enormous level of AI spending would generate returns quickly enough. On July 29th, the Nasdaq fell sharply, the S&P 500 declined, and the Dow Jones Industrial Average lost more than 1,100 points. Several companies associated with artificial intelligence and advanced chips suffered significant losses. But the most revealing part was not simply that stock prices fell. Markets rise and fall every day. The important signal was why investors were selling. For years, announcing more AI spending could push a company's stock higher. It showed ambition. It showed confidence. It suggested that management understood the future. Now, the same announcement can frighten investors. More spending may mean less free cash flow, less money available for dividends, less money for share buybacks, more pressure to borrow, and a longer wait before the AI investment produces meaningful profits. Wall Street has not suddenly stopped believing in AI. It has started demanding evidence. This is an important rule of financial markets. A company's stock does not fall only when the company performs badly. It can also fall when the company performs well, but not well enough to justify the expectations already included in its share price. Imagine that a stickman buys a small lemonade stand for $100. The stand earns $10 per year. That may be a reasonable investment. Now imagine that excitement pushes the price of the same stand to $10,000. The business has not become bad. The lemonade is still popular. Customers are still arriving, but the price now assumes that profits will grow enormously. If the stand earns $15 instead of the $100 investors imagined, the investment may collapse, even though the business itself has improved. This is the problem facing many AI-related stocks. Their valuations do not simply assume that artificial intelligence will succeed. They may assume that it will succeed quickly, produce extremely high profit margins, and allow today's market leaders to remain dominant for many years. Anything less can feel like failure. The wider economy is making this challenge more difficult. The Federal Reserve has maintained its benchmark interest rate range between 3.5% and 3.75%. Higher interest rates increase the cost of borrowing and make future profits less valuable in today's money. That matters especially for companies whose biggest profits are expected many years from now. At the same time, rising energy prices can increase the cost of operating power-hungry data centers. When oil, electricity, borrowing costs, and equipment prices rise together, the AI machine becomes even more expensive to feed. Investors then begin looking elsewhere. Some move money toward banks. Others choose healthcare, energy, industrial companies, or businesses that already generate strong cash today. This movement is known as market rotation. The money does not necessarily leave the stock market. It moves from the most expensive and fashionable part of the market toward areas that investors believe offer better value. Picture a crowd of stickmen standing beneath a giant AI sign. For months, almost everyone is looking in the same direction. Then one person notices a smaller sign marked banks. Another sees energy. Another sees healthcare. Slowly, the crowd begins to divide. This does not mean the AI sign falls immediately. It means AI companies must compete for investor attention again. They can no longer rely only on excitement. They must show revenue. They must show customers willing to pay. They must demonstrate that every new billion invested can eventually produce more than $1 billion in economic value. There are still powerful arguments in favor of the AI boom. Demand for computing continues to grow. Companies are integrating AI into products used by millions of people. Advanced chips remain essential. Cloud providers are expanding their capacity. And some AI investments may take years to reveal their full value. The first years of building electrical grids, railways, or internet infrastructure were also extraordinarily expensive. Nobody expected a power station to repay its entire construction cost during its first week. AI infrastructure may follow a similar pattern. The spending could appear excessive today and still prove necessary for the economy of tomorrow. But the opposite risk must also be taken seriously. Companies could build too much capacity. Competition could push AI prices downward. Models could become cheaper to develop. Customers could refuse to pay enough for premium services. Open source technology could reduce the advantage of the biggest companies. And some data centers could become outdated before they earn back their construction costs. The truth is that nobody knows exactly how large the final AI economy will become. Nobody knows which company will dominate it. And nobody knows how much today's infrastructure will eventually be worth. That uncertainty is where both fortunes and financial disasters are created. The greatest mistake would be to reduce the story to two extreme choices. Either artificial intelligence will conquer everything, or the entire industry is a fraud. Financial history rarely works that way. The more realistic possibility is that AI is a genuine revolution surrounded by pockets of excessive spending, unrealistic valuations, and companies that will never recover the money they invest. Some winners may become more powerful than anyone currently imagines. Other companies may disappear, and some investors may discover that choosing the correct technology is not the same thing as choosing the correct price. The AI boom may not be running out of ideas. It may not be running out of users, and it is certainly not running out of ambition. But it is beginning to run out of something that every financial boom eventually needs: unlimited patience. For years, Wall Street asked technology companies only one question: how fast can you build? Now it is asking another: when will this start making enough money? The answer could determine whether the AI era becomes one of the greatest wealth creation stories in history, or one of the most expensive financial lessons the world has ever seen.